Hello, hello, hello. Welcome to our live today. We're talking about 5 debt myths that you need to stop believing right now, as in ahora, at this moment as we are live, or if you're watching the recording, at this moment when you're watching the recording. It's really sad. Debt is hitting all-time highs here in America, and we all kind of know why. It's chaos out there. But here's the thing, when you break it down, the average American is paying $8,000 per year in interest alone. That's ridiculous. That's $667 per month. Can you imagine if your cell phone bill was $667? You'd be looking for a new carrier, right? Like, let's get this interest out of our lives. And it's not necessarily the debts, but sometimes our beliefs about the debts that actually cost us even more than the interest on the debts. They cost us what we could be doing instead, the future we could be creating. We're going to talk about all of that today with 5 debt myths. And we're going to end the session with helping you identify good debt, avoid costly mistakes, and potentially save you thousands of dollars or help you create thousands of dollars for your future as we go here. So as people are coming in to the live, I want to say a little bit of what we're talking about today for those that are catching the recording. And you'll see my esteemed guests here that are going to, not guests, collaborators, amazing people that are going to help introduce themselves, share a little bit about who they are, why they're showing up today, and what they're excited about before we jump into the debt myth. So who wants to go first?
I think I want to go first, Amanda. Can I?
Yeah.
So as you guys see, we have new faces here. We are going to be doing some fun stuff here. We're growing our team here at Wealth Wisdom Financial. So you see Christy and Stephanie. They are part of our team, and we wanted to allow them space. It's not just the Amanda and Brandon show. I mean, I know you guys like us, but we really wanted to bring other people into the fold because we learn a lot. We always have Mark here, but this time we get to have Christy blank last name there, and Stephanie Nelp. And while you guys are here, don't forget, write comments, like, post, do all the things, share this, because we want to eliminate this craziness that's happening in the debt world. We want to be able to help you build a stable financial future. Debt sometimes is okay, sometimes not. We're going to talk about that today. So with that, you guys introduce yourself and comment here.
So I'm Stephanie Nelp. My company is Foundational Wealth Builders, but I work very closely with the team here, particularly Amanda and Brandon. And I am so excited about this topic today because I used to be really debt averse myself and have now realized there's a difference between good debt and bad debt. So we'll get into some of that later, but I'm really excited to be here.
Hey, I'm Christy. I work with Brandon and Amanda in office. I'm got my master's in finance, and then found this unique company that it changed all of my views on everything I learned. It upturned everything that I thought I knew about finance. So I've been relearning all of that on this awesome journey with them, and excited to talk about debt and how you can use it to your advantage.
Yay, love it. Okay. I'm going to do a little screen share, and we're going to talk a little bit about what everyone can expect today. Here we go. So we're going to talk about 5 debt myths. Really funny story just earlier. I was reviewing the P&L for a business owner and saw their largest expense for 2024 was, you guessed it, interest. Interest paid to others. Bananas. So we want to stop that. And part of why we need to stop, part of what needs to happen to stop that is there's a big financial literacy gap in America. Fewer than a third of Americans understand how interest even compounds, the difference between simple interest and compound interest, what the calculations look like. Don't worry, we're not going to nerd out and show you a bunch of calculations today in detail, but we're going to go over some big numbers that kind of hopefully will help us all learn some things. And the problem is that the media, financial institutions, they often oversimplify financial concepts. We're here to simplify without oversimplifying, to give you kind of the real math without having to go through all the details of the math, but also without being like, and this applies to everyone all the time in all cases, which is often not true. The other thing is that those who do learn about debt often learn about it from family, and that often perpetuates myths rather than counterbalancing myths, or people learn just through painful experience, and then they react and kind of take the pendulum the other way. And all of these kinds of things we're talking about, the media oversimplifying, inheriting myths from our parents and grandparents, painful experiences that kind of skew us in unhealthy directions, all of those cost us real money. And we think most people, like if we're paying $8,000 in interest, we could probably save about half of that through just better debt management. Not that you have to be totally out of debt immediately. So we're going to go through these 5 debts. Here's the debts on my screen that we're going to go through. We're going to talk a little bit about credit cards, Parent Plus loans, like for college, mortgages, reverse mortgages. If we have time, we're going to talk about 401k loans, and then we're going to talk about all debt, and this all debt is bad debt belief that a lot of people have. And we're going to talk about why people believe each of these debts and why they're what they often believe is a myth and why it's not true. So before we jump in, anything else anybody wants to add at this point?
I would add, make sure as you're talking, Amanda, P&L. Some people don't know what that is. So what is a P&L?
Yeah, it's a profit and loss statement for a business, what their profit was, what their or their income was, what their expenses were, and then it has profit at the bottom. We throw things on reverse with profit first, if you're familiar with that concept. So that's why I screwed up there. I'm thinking profit first rather than income minus expenses equals profit. But yeah, we looked at, here's their income, here's their expenses, and the largest line item on that is expenses, was interest payments to others.
Yep. Just want to make sure. Sometimes people are like, oh, wait, she's already talking over me. I don't know what that means. Yeah, there you go.
Okay, we ready? Jump in? Everybody got their snorkel outfits on?
And so you guys know, comment. We want to hear from you. We might veer off if you have a big question. We want this interactive.
Okay, so here we go. Myth number 1 revolves around credit cards. And here's the myth that a lot of people believe: if I pay my minimum, my credit card balance will go down quickly. If I just pay my minimum, I'll get out of credit card debt quickly. The minimum will do that, right? Now, with some debt, that's true, right? The minimum is calculated in a certain way that it goes down faster. An amortized loan like a mortgage, the greater and greater share of the payment goes to the principal with each passing payment. But credit card companies, we believe that they're on our side. So we believe that, bigger is better. Bigger is going to be more trustworthy. I can trust the minimum payment. They're doing what's in my best interest. Right? That's what it's a myth. I'm trying to, why we believe all this, right? Mm-hmm. Also, the credit card companies are really good at making it easy not to see what you're paying in interest, or, principal and interest, how much is going to principal, how much is going to interest, especially if you enroll in paperless and save money, right? They tell you we'll lower your interest rate if you enroll in paperless, but then you often don't even look at your statement. And then if you do look at your statement, the interest is on second, third, or fourth pages at the end of the statement. And you have to actually open the PDF, find it. It's not really anywhere when you just first log into your account. And the monthly statements will also, if you look carefully at them, they'll put the minimum payment in bold, extra big font in color, while the rest, the full balance, all those kind of things is much smaller, less prominent, less transparent. Anything else you guys can think of why people believe this myth that they pay their minimum, their credit card balance will go down quickly?
I think people see this as a service for them. And you have to remember, at the end of the day, the credit card companies do still need to make money. And trying to entice you to just pay that minimum balance is one of those ways that they do so. And a lot of credit cards these days come with some sort of rewards points, which sounds really exciting. But again, you have to remember they're making that up in some way. And this is one way they do that.
Yeah, it's really good.
And the convenience, right? The convenience charge that we don't realize we're paying. And at the same time, remember, as you look at your reports and all that, it's always on the 6th or 7th or 8th line, making sure we understand that that whole math thing and what they want you to see, those big letters blinking in blue or whatever, to pay the minimum, that is for their benefit, not ours. And so really understanding, you still use credit cards. We have some, but understanding that they're in the business to make money. The credit card companies and banks, as you guys have heard this many times, are the most profitable business in the world. They didn't get here by accident.
Yeah, I think a big misconception I just want to highlight on that is that they have your best interest in mind, and that they're when you take out that debt, they're going to help you. But really, yeah, they're lining their pockets. They're finding a way to get their dollars. So it's not, you just have to know who is for you, and really take charge of your own wealth there and knowing what to do.
Yeah. Okay, so here's the big mindset shift. You ready for this real math, real story? So the way that credit card companies calculate minimum payments is it's typically 1 to 3% of the balance plus interest. The way that this would work, we're going to be doing a this or that. So this is what the credit card companies do, and then that is the way that you can maybe outsmart the credit card companies and reduce the interest that you pay to them in your pocket. So here we're doing a 2% minimum payment. As your balance goes down, your minimum payment, the one that's in the bigger colorful letters on your statement, goes down as well. So if you've got an auto payment set to always pay your minimum, you actually see your payment go down over time. Compare that to, let's say, whatever your minimum payment is today, you add $50 to that, and you set up an auto payment to pay that every month, right? And always that on, the day before your due date or something like that, so that you're, budgeting for that, exactly what to counter on, but it's not going down, it's staying flat. Well, if we apply those two to a $5,000 credit card debt, balance that you have, and if you're paying 18% interest, which a lot of people pay way more than that, we're just trying to use a simple number here, 18%. If you pay the 2% minimum, remember the payment's going down until you get to about $25, and they don't want you to send in $5 or $10. So they keep it at $25. You would pay over $7,500 in interest alone, which means you'd pay back your $5,000 plus another $7,500. So you pay back $12,500. If you never charge another dime, right, you're just paying that interest. And it would take you 22 plus years to pay it. Not 22 months, 22 years to pay it off in full. I saw somebody say this. I put it into an Excel sheet. I did the calculations. I confirmed that is legit. That is true. Compare that with if you're just paying, $150 a month, right? The minimum starts at $100. You add $50. You end up only paying a little less than $2,000 in interest, and you're done in less than 4 years. It's like 30 some months. How cool is that? Like, why not? If you can pay $150 today, keep paying that $150 until the balance is gone out of your life for good. And again, this is as if you never charged another dime of interest. So the minimum payment, I call this a trap. The minimum payment trap is that as your balance decreases, so does your minimum payment, which extends the payoff time and extends the amount of interest that goes to the credit card company. So always pay more than the minimum, even if it's just $50 a month. That reduces how much you pay dramatically and gets it paid off a lot more quickly. And then even better, if you can set aside some intentional time, you just got a tax refund, just wipe out that balance, never go into it again, right? Get some kind of raise, you increase how much you're paying per month, like have fun like that too. But at least now, never just pay the minimum. Before we go into debt number 2, anything y'all would say more about this?
I mean, just what a massive difference that makes. It's so wild.
I might add, this is where where Dave Ramsey gets some of this stuff right, is understanding that snowball or interest. That's the 1 part of where he yells at us. I like how he's yelling, at least in this regard sometimes.
Okay. That's debt myth number 1. Now let's move on to debt myth number 2. I'm going to hand this one over to Stephanie, and she's going to go through this one. This one just blew my mind when I learned this before.
Awesome. Yeah, so there are many different ways to pay for college out there for your kids, but one of the popular ones are Parent Plus loans. So a lot of people think that Parent Plus loans are the best way to pay for college. Now, that might not necessarily be the case. If you are a parent and you have not yet saved for college and your child's about to go off for their first year, this might seem like a great option on the surface, but really the problem with this is you are taking out the debt as the parent instead of your children starting their lives in debt. So you see it as a really valuable thing because you're helping to set your kids up for success by sending them to college and then graduating debt-free. But the problem becomes that you personally are taking on this debt, which can have a lot of negative impacts if you're not careful with it. I'll open it up to everyone here. What do you see as the biggest concerns with Parent Plus loans?
I'm trying not to answer.
Because we're about to show it an example.
Fair enough.
Yeah. The comments are open too from our audience. Since you don't know the answer yet, maybe you could react here, even if you're watching the recording. I don't know, if I just took out a Parent Plus loan and then I need a loan for something else, like I'm getting into real estate or I'm going to apply for a mortgage, that can really impact my ability to actually use debt wisely if I decide to do it. Because that Parent Plus loan shows up on my income to debt ratio, right? My credit scores impacted, all those things as a parent as well.
I'd say a lot of reasons why people do it is because they didn't maybe plan for the college, and they're like, oh, well, I'm going to help them. And they don't have a history, the kid. So guess who's co-signing? Mom and dad. And the easiest way, Parent Plus loans, they sound amazing because it has the word plus in it. So it sounds better, I guess. It'll make more sense. But, you're going to show the math. Sometimes not so good.
Yeah. And I think the other thing to be aware of here too is who is paying off this loan. The Parent Plus loan is in the parent's name. So it's the parents that are responsible for paying it off. However, I have also seen cases out there where parents might take out the loan in their name, but then expect their kids to pay it off once they get a job after college. And so just being really clear on who it is that's actually going to pay that back so that parent and child are both crystal clear on the plan. That avoids any potential confusion later on if you are going to go down this road. But even with that in mind, keep in mind that these Parent Plus loans, they don't wait until the child graduates college. You have to start paying these back typically pretty immediately.
Yes. And so it's not like we get out of paying for college for 4 years. We have to start paying for it the minute we take the first loan. In addition to whatever we have to pay otherwise that we weren't able to take a loan for.
I mean, I've had so many clients that, like they talk to us, they have this loan for their kid. Their kid's now making plenty of money, but the parents still paying the bill because they never actually had that conversation with, hey, I'm going to help you. Help me, so I've told some people as we're helping our kids, we want to, like, that's the point. However, you're going to be sleeping on their couch maybe because of those Parent Plus loans and not have a retirement account. And so we have to think about what's that really costing us and them in the long run.
Yeah, absolutely. Well, should we jump into an example?
Yeah, go for it.
Yeah, let's talk about why this myth is false. Let's do it.
Awesome. So there are a couple things to be aware of with this. So if you look at a Parent Plus loan versus an alternative type, let's take a look at a HELOC or a home equity line, for example. So you could have the same interest rate with the Parent Plus loan and the home equity loan. But what you might not be aware of is these Parent Plus loans come with an added origination fee. Right now, that tends to be about 4%. So that's another 4% on top of the interest rate that you're already being charged for this loan. Pretty
Bananas.
wild.
Yeah.
And that can catch a lot of people by surprise. And you'll see in this example how that can really add up with a lot more interest than you would otherwise need to pay.
But
Yeah. So walk us through this.
but the kids need college.
Well, we're still paying for college. In this example, it's $30,000 as a Parent Plus loan versus $30,000 taken out as a home equity loan. So Stephanie, walk us through this. Here's the Parent Plus loan.
So $30,000 for college. We're taking that loan out as a Parent Plus loan. This is a loan at a 9% interest rate, again, with that added 4.2% origination fee. The term is going to be 120 months, and that's going to start immediately. So unlike a student loan where if they take out debt to pay for college, they'll be able to delay that payment until after they graduate. It's not the case for a Parent Plus loan. So that payment is going to start regularly immediately. And you'll see in this example, with a payment of $397 a month, you'll end up paying almost or a little over $16,000 in interest alone over the course of paying back this loan.
Yeah. So that year of college, right, if it's $30,000 a year, didn't cost $30,000. It cost how much?
Yeah. So now you're paying $46,000 in total.
Oof.
For just 1 year or maybe even one semester, depending on the college.
Yeah.
So then on the flip side of things, if we look at doing this with a home equity loan, so taking out a loan of that same amount, let's assume same interest rate for the scenario, but no origination fee. So that's going to make a big difference here. And then the term is going to be a bit longer, but let's just assume that you're going to have the same monthly payment as you would with the Parent Plus loan. So if you allocate that same amount to this home equity loan and paying that down over time, the total interest charged is going to be $12,000. So in total, you're paying about $42,000 for this loan, but that's a lot better than the Parent Plus alternative. Pretty wild. What did everyone else think of this?
Well, and then we've got the asterisks next to the payment. I forgot to bring this up here too.
Yeah, so that's, I believe, because it's not the minimum, right? So you could pay less, but again, looking at apples to apples here, Parent Plus loan having to pay $397 a month. If we look at putting that same amount towards this home equity loan, that's where you get to pay this down a bit faster and end up paying less interest.
And I also like to fast forward. Let's say you're 6 years into this. Hopefully your kid's done with college. If you needed another loan, they're not going to give you another Parent Plus loan. Your kid's done with college, right? Like that's for education. But I could theoretically tap back into the equity of my home and take out another home equity loan, right? And I have experience with that. I built a relationship with a lender. The more I pay on it, the more I'll be able to use again. Not true for the Parent Plus loans. I never thought about that until I just looked at these side by side here.
Yeah, definitely. So if your child needs a little bit of extra help getting prepared for the real world, maybe getting their footing with that first apartment, you're able to help them out with that, whereas you couldn't with that Parent Plus loan.
Yeah, or if I need to buy a new car, or all kinds of things. Yeah, pay off my credit cards like we were talking about before.
I think, again, is maybe we just see one side and we're like, oh, this is going to solve one thing, right? And we aren't very aware. And so we say, well, I'm going to get this. My son's going to go to be a doctor, so that's going to make up for it. And we don't realize the true cost. And so we're in this episode here, as you guys are watching, true cost. Have you guys ever experienced that? Has this happened to you? Or have you kind of gone back 5 years later and said, oh, wait, I didn't realize. I'd love to hear that in the comments. We want this interactive. So not just the Brandon and the girl team.
And as we wait for those comments to come in, I just want to highlight again something that Brandon mentioned earlier, but I think is really important here. So if you are a parent and you're taking out a Parent Plus loan for your child so that they can go to college, you might be putting your retirement at risk or minimizing the amount of money that you have for your retirement because you now have these loans that you have to pay back. And on top of that, that's assuming that you have good enough credit that you can get a Parent Plus loan in the first place. So that's something else that parents really need to be aware of when they're looking at options to pay for college.
Yeah. That's a really good point. And we should also emphasize these aren't the only two options. We just want to kind of show these as common options that people look into. Most common, the Parent Plus loan, because everybody's promoting those, including this financial aid office at the university. And then kind of maybe the second most common are these home equity loans, because that's where a lot of people have their wealth is in their homes. People will also use loans from retirement accounts, which it absolutely puts their retirement at jeopardy, and so on and so forth. So it's not like these are the only two options. And I'm glad you brought up that's a good, whatever way you're thinking about paying for college, to think about how it'll impact your eventual retirement is a very good point to consider.
Again, I think about like some of the people I'm talking to are like 72 or 73, and they still have Parent Plus loans. I'm like, how do you still have a Parent Plus loan and it doesn't look very small either? And it is crazy bananas what some of these things we see.
Yeah. There's deferrals and income-based repayment similar to student loans for Parent Plus loans too that can get people in even worse trouble. Yep. Yeah. Okay, I think we beat this myth pretty hard. Are we ready to move on to number 3? Myth number 3?
Yeah, I'm ready. I'm ready for that one.
Yeah. Okay. Brandon's leading this one. Go ahead, Brandon.
Yeah. So now we have the paying off my house early. I got an amazing rate on my mortgage, and or other things. Maybe they don't pay off because they have an amazing rate on their mortgage. I shouldn't touch my home equity. Shouldn't use it because I got it in 2022. It was 2.99. Now, I mean, interest rates, I don't know. Have you guys looked how much interest rates on a house is right now? 6, 7. Is that good now? I don't know. Compared to what? I don't know. So I've heard this. I've got an amazing rate on my mortgage. This is another reason that we also have relationship with mortgage people that can help us think, because not everything is the same, right? So go ahead and move to the next slide there.
Well, yeah, just talk about like more about why people believe this is a myth, right? Not just the change in interest rates, but also like getting a mortgage is complicated and stressful. I'm done. I don't want to go through that process again if I don't have to.
I do.
There's also,
I think that there's sometimes we've been told that because, back in our and this is why it was grandma's wealth wisdom back in the day, it was like lower interest rates or different things that we would think through, right? Sometimes we're scared of pulling that out. We want to have that paid off house. I've had so many people are like, well, I don't care if it's 2.5. I want to pay off that house. And so they want to be mortgage free. So they don't want to touch it, even though they know if they use that equity in a smart, systematic way, that they can make more money. They don't, in that regard, they're not business owners, right? And so they don't understand the true cost or opportunity cost. And why would they touch their interest rate if it was in the greatest time of all time post COVID to buy a house? Why would they touch it now, right? That would be ridiculous because it's 7% versus 2%, right?
Yeah. I pause for a second, Brandon. We've got a comment from D. I'm going to show it on the screen. It was about the last myth. So we're going to, before we move on to talking about why this one on the screen is a myth here. One thing you'll notice, D, is she's asking, is there a better alternative to Parent Plus loans outside of just saving? So we talked about home equity loan. If you own a home, that is an option that people use. People also use options like they can take penalty-free withdrawals from some retirement accounts, but not others. They can take loans from some retirement accounts, but not others. Some tap into family. There's lots of different ways to pay for college. If you want to learn more, we have some great colleagues and friends that are college funding specialists that help people figure this out, and we'd love to chat with you about it. But the home equity loan is one of those common alternatives other than just saving, which savings is really great too, if you can do that. And having your kids save from that college or from the summer job, or if they work through high school, those are really great options too. There's probably more than we could cover at this time, but I really appreciate you asking that. Okay, now let's go back to, I just got an amazing interest rate. Why would I touch my equity?
Yeah. I've heard this many times, and usually they've been in the house for a while. They got this great house in 2022, so now they paid off a bunch. So now that we touch the equity, and again, sometimes I'm speaking to myself. We have that great interest rate, and we have equity, so we're like, playing around with this. So let's go through some numbers here, Amanda. So let's say you have a home equity loan of, you could do this at 100,000 at 9%, right? Keep going. Versus 100,000 growing at 5.5 per year. Like that's which one looks better, 5.5 or 9? Are you going to add something?
Well, and if you had both of these, would you take that 100,000 that's growing at 5.5% and pay off your home equity loan? Right, they're equal. You've got the savings. Would you pay it off knowing your home equity loan is 9% and that 100,000 is only growing at 5.5%?
Let's do some math and see, right? So we have the loan, interest rate's 9%, term is 360 months. That's a little bit of time. Payments, we pay $804, and interest charge is $189,000, right? So this is the 9%, how much it would cost us. And then we have the other side, account balance is 100,000, interest rates lower, 5.5, term is 360 months. We are not making any payments. And the balance, of course, is in 30 years. Amanda, why are we not making payments on this one versus this one?
So the home equity loan is showing the interest that you would pay if you didn't pay off that loan with your 100,000 sitting in that other account growing at 500,000. And most people be like, I don't want to pay $190,000 to the bank that I have this home equity loan through, right? Like, I'm going to pay off the loan. But they forget that 100,000 compounding at 5.5%, a lower rate of return than the interest rate on the loan, ends up in the same time frame, 30 years, making $518,000 plus, right? So do you want to save 190,000 or do you want to make 518,000?
Yeah. So,
or actually really make 418,000 because you have the 100,000 that you started with, never adding a dime to it.
So this is like, again, using that same money and making money, right? So there's a difference, right? 518 plus versus negative 189.
Yep. And then for those who might not be familiar with a home equity loan, this is a newer product that was created. It's not a cash out refinance. It is a second loan or an additional loan that you get so that you don't touch your original mortgage that's at a really good interest rate. And the interest rates might be less than 9% now. We kind of did this as an example. You could have more or less.
But again, what it's showing is like having money, making it or using it, right? And so maybe you might take a home equity loan to create other cash flowing assets, or why would you use even though my interest rate is low, maybe we take out the home equity loan to take out a lot of high interest credit cards, going back to number one, right? So 22% may be way higher compared to even 9%, right? Just doing the math and saying, well, which is better? And then of course I'm a business owner, so I'm going to try and do things that create wealth, not liabilities. What questions do you guys have on that one? I think we had another comment here. Oh, she said, okay, great, thanks. Oh. Have you guys ever experienced
Stephanie, Christy, anything you'd add?
Yeah, I mean, I guess I would add, in this scenario, it definitely seems to make a lot more sense to be saving that money, right? And building that up so that you can use it. But people shouldn't necessarily shy away from something like a home equity loan or tapping into the money that they have sitting in their house if they feel comfortable with it. So to the earlier point, there are a lot of people who want to just know that their primary residence is safe and secure and there's no risk of the bank coming after them. And that's okay. There's definitely something to be said for that. I personally am a real estate investor and have learned how to leverage some of this debt in a positive way. And I love the idea of something like a home equity loan and tapping into the growth that your property has appreciated over time. And if you know how to use it properly and you have a payback source that you plan to pay this back over time, it can still be a very valuable tool to use.
And I want to go back to, that's why we kind of put this out here for the listeners, and having like the bank yourself, infinite banking policies that we put in, but also having relationships with the mortgage people that are talking to each other. Like have a good relationship with the people I introduced that do the mortgage side. And so having that kind of dance from a financial point, and in the end, what I really want to grow in this for the people that are listening is I want them to be the master of their ship. They need to understand how that works and how they didn't just buy a house just for fun, right? Typically.
Yeah. I mean, question all your financial professionals, right? You're the one driving the ship at the end of the day. So it's important that you're asking the right questions and, pressure testing. Is this the right move for me in my situation?
Awesome. Cool. Well, if you guys have questions on that, put it in the comments. We'll come back to it. But let's move on to our most favorite one. Sometimes, not really.
No, I'm going to go through this one quickly. The fourth one is reverse mortgages are a scam, period. Right? Like, no, don't ever do a reverse mortgages. They're the most horrible thing. And I would say previous to the financial crisis of 2008, that was probably true. Reverse mortgages were oversold to seniors with little oversight, little suitability standards. They needed more regulation and oversight to them. And thankfully, that is now put in place. But there's lots of, horror stories in the media about seniors losing their homes because of reverse mortgages from that time period, and occasionally still today. So these are complex. They're difficult to understand. That's why if you're going to get one, there's a lot of hoops to jump through. And they can have higher fees or higher interest rates than conventional mortgages, higher closing costs. And hands down, there's been a lot of aggressive marketing of reverse mortgage that have made a lot of people feel like it's very scammy. So we're going to talk about why a reverse mortgage could be appropriate for someone. So when it's not a scam, even if it is a scam the majority of the time, if that makes sense. So one thing to know is that there are a lot more regulatory practices in place for reverse mortgages. It's called the HECM program, HECM. It's a home equity conversion mortgage is what that stands for. And there's been a lot more protections in place for those going forward. And what makes them really fun is that they can lock in the home's value and the bank takes the risk. So would you say, pull the audience here. You can say this in the comments or you can come live. I hear Brandon just unmuted because I can hear my echo on his line. There we go. Would you say home equity is at a high or a low right now? Are home values high or low? If you're watching the YouTube, you can say hi, or on Facebook or whatever, say hi or low in the comments. Christy, Brandon, Stephanie, I'd love to know. What do you think? High or low? Home equity, is it high or low right now?
Depends on which market you're in, but overall, I'm going to say high.
Yeah, I would say high.
Yep, I agree. It's overall.
Yeah. I know when I'm a little bit of a nosy neighbor / I love just looking at my neighborhood and what homes are for sale. So I've got the Realtor app on my phone and I'm always looking. They've got this chart at the bottom that shows, how the homes value has increased or decreased over time, and they're always up, right? Like, and especially a big spike, since 2020, as lots of people were getting, buying homes. There's lack of inventory. We might see some of that cooling now. We've talked, Stephanie mentioned there's some cooling happening in different locations, that kind of thing of the market, maybe not as hot. But let's say you're a senior. We're going to talk about Mary and Martha in our this or that for this one. And the green is going to be Martha, an appropriate use, and then we're going to talk about Mary is going to be the inappropriate use. So let's say you're a 78-year-old widow and you're watching this YouTube video, or your mom, you referred it to her and she's watching this. She's a 78-year-old widow with limited retirement savings, and Social Security is barely covering the expenses, right? We've had huge inflation. The Social Security cost of living has not really helped a lot with that. And, Martha's starting to get a little old, right? Not old yet. You're only as old as you feel, but starting to feel like there could be, I want to stay in this house. I don't want to go to a nursing home. I don't have to go live with my kids. I want to stay here. And so I need to do some modifications to make sure my home continues to be accessible. Installing a ramp, putting some, railings in the bathroom, et cetera, right? And kind of imagine those. That's a great time to use a reverse mortgage, because Martha is able to tap into the home that she owns. Maybe she owns it outright and it's $350,000. And she could tap into that, take a lump sum for $30,000 to maybe make those immediate home improvements, have a monthly payment to supplement her income. You don't have to take all of the home equity all at once. And then it's also a line of credit that she's already approved for that she can use if she has some future medical expenses or does need to go into a nursing home temporarily, or, something like that. This works because it keeps Martha in her home. It supplements her income. It keeps her ownership while she's still alive. There's no mortgage payments like there would be with a cash out refinance or a home equity loan or something like that. And her children, in Martha's case, support this decision because they just understand we're not going to have to deal with this home that we don't even want when, mom, goes to the other side, goes to greener pastures. Great example of this might be a good time to look into a reverse mortgage, see if it makes sense, and lock in that home value so that if Martha lives to 100 or beyond, she's able to continue using that no matter if we have some kind of real estate market bubble burst, right? Now let's compare that with Mary. So Mary is 62 and recently retired. Wants to enjoy, this should say her 60s. And so she's thinking about taking out home equity or taking out a reverse mortgage to enjoy her youth, right? Travel, get that dream car while she can still drive, all the things. And in this case, it's probably an inappropriate use because Mary's still relatively young. And this limits the potential benefit, right, over the long term. There are those upfront costs, origination fees, mortgage insurance premiums. Those can be substantial. And to pay those costs right at the beginning of retirement, that impacts the rest of the financial future for Mary. The proceeds are being used for discretionary spending rather than necessities. We didn't talk here about other income sources that Mary might have, but maybe Mary has other ways to pay for these things rather than the equity they have in their home. And really, it's all about the long term, right? Let's say both Mary and Martha live to 100. Martha's got 22 years to 100. Mary is 38 years to 100. That's a lot longer for that interest to be building, the things to come up that, completely derail this. And so a very good, okay, we need to factor all these things in to account. Make sure if you're going with a reverse mortgage, don't just assume it's not appropriate or assume it is appropriate. Kind of weigh the pros and cons.
I would say, because I always have to say something, right? Is I remember having a client that was around in the 80s and heard about reverse mortgages, how bad they were, and were very wary of it. But she ended up doing one because I introduced her to our friend, and it was mainly because she had too much month and not enough money. And so we needed to figure out a plan for cash flow, right? And so she was trying to work a business, trying to do all this fast rate of return type stuff because she had a gap. So I was like, well, wait, you have a paid off house. Like, why aren't you somehow systematically using that for I don't know, eggs or whatever she was buying at the time, right? And so she did that, and she came back to me later. And we didn't make any money off of this, but it was just an introduction to our friend, and said maybe you should consider this. And she said that was one of a really good decision that gave her peace of mind, because now she had that for her and her husband.
Yeah. And helped avoid all the credit cards that they probably would have, gone into debt and paid much higher interest rates on.
And I said, we need to do something maybe. And that helped to at least stop the bleeding.
Yeah. Love that. Okay, we've got a bonus myth, and then we've saved the best for last. All debt is bad, and we're going to hand it over to Christy for that one. For this one, we're just going to talk really quickly about 401k loans. A lot of people, this is their first go-to. Something to remember is that 401ks haven't been around forever, right? First implemented in 1981. And for many of us, this is all we have for retirement, right? Throughout our entire adult lives. So when it comes to taking a loan from that asset, it's a natural place that a lot of people turn. And this whole idea of paying interest to yourself sounds really appealing. There's no credit check required, right? There's lower interest rates than some of the other alternatives, no impact on your credit score. So it's why people believe this myth with 401ks. That's where I'm going to go first. But one of the things that a lot of people don't realize is that the interest that you pay in a 401k, you don't get any tax deduction for it now, right? Plus, you pay taxes on it when it comes out as income in retirement. And so that interest is being taxed twice. Bananas.
Wait, can you say that again?
Yeah. So the interest that you pay on your 401k loan, you don't get any tax deduction for it like you do your contributions to your 401k, right? You're paying back the loan with interest. That interest doesn't get a tax deduction. But then it's in your 401k balance. And when you take money out of your 401k, you do get taxed on it. Twice. Yeah, paying taxes twice. There's also limits in how much you can take. So don't think you can take your full balance or, millions of dollars out of this at once. You're limited to about $50,000 or 50% of your balance. If you leave or lose your job while you have a loan outstanding, the balance comes due immediately or within a certain time frame. You have to repay that loan. And then there's also this idea. So the this or that for this one. You have a 401k, take out $10,000 over 5 years versus leaving that $10,000 invested. Well, what if you lose your job, right? You got to pay it back if you take that out. Do you have $10,000 that you could pay that back? Well, if you did have the $10,000, why would you even take the 401k loan in the first place? And then, leaving it invested, well, are you going to pay interest somewhere else, right? Do you have that credit card that you could pay off of the 401k loan? This isn't a good, bad. It's a unique situation. Everybody needs to make a good decision. And think about opportunity cost and the long range as you're making these decisions. I think it was Brandon probably that put that. Not a fan of paying taxes once, let alone twice. Great. Anything else here? Are we ready for debt myth number 5?
I just want to highlight that paying taxes twice one more time because it's so important. And, I've talked to a lot of people who do think about taking a 401k loan, and their thought process with it is, well, the interest gets paid back to my account. So, I'm paying myself that interest. That's great versus paying that interest to a bank. But again, not so great because you're being taxed twice. So that right there is a very well-known myth, I would say.
Yeah.
Okay. I would want to go add in the whole using the policy, life insurance.
Well, that's where we're going. Don't get ahead. Don't get ahead.
Because I'm like, man, there's a better way than 401ks. But
yep. We're going to pass it over to Christy. Let's go, Christy. Number 5. Save the best for last.
Okay. Awesome. Yeah. Let's dive into a topic that affects almost everyone. Debt. We've talked about mortgage, credit cards, student loans. There's also, business investments, stuff like that. Debt really plays a role in everyone's financial lives here, but as we're about to find out, all debt is not created equal. There's some types of debt that can help us build wealth, create that financial security. And there's others that can trap us in a cycle of stress and hardship and, just put us in a bad hole that we have to dig ourselves out of. So I like to think about it this way. A knife can either prepare dinner or it can cause harm. And, in the same way, that can be a tool for financial growth, or it can be a trap that leads to financial ruin. I think the most important thing here is to know the difference between, good and bad debt. So a lot of times people, we've grown up, people around us believe that, all debt is dangerous. We're not really taught about it in school. We don't really, learn about it specifically, unfortunately, in our classes like we should. Then also, there's a lot of different, religious beliefs that reinforce the idea. For example, Romans 13 says, "Owe no one anything." And there's also a law in Islam that forbids charging interest called riba, and it considers it exploitative. There's also, of course, financial gurus, Dave Ramsey, others like him that promote that cash-only lifestyle. As the ultimate financial goal. There's, good and bad things about that. And then also just, us ourselves, you might have had a bad experience in the past with debt, having, credit card debt or high interest loans in the past. And that could create an aversion, like some sort of emotional aversion that would, make you want to just avoid debt altogether. And for some people, all debt, any bit of debt is bad. But for others, debt can be used as a tool to create wealth. Yeah. But you can do better than just being debt-free. And let's talk a bit about good debt and bad debt. Good debt is that low interest debt that helps you build wealth, and it increases your assets. Bad debt, that's going to drain your finances, create liabilities, and it's not going to add any value to yourself or your net worth. There's really two types of assets, appreciating assets that can build that wealth, and then depreciating assets. And, they're usually associated with the good and the bad debt. And, for example, owning real estate, like Stephanie mentioned, she holds real estate, where tenants are paying the mortgage, and your property is appreciating, that's a good type of debt. And then also, as we're going to talk about, I'll just hint at it, using bank on yourself policy loans can also be a good type of debt. A good book that really explains this concept is Rich Dad, Poor Dad by Robert Kiyosaki. And he talks about how good debt increases assets more than liabilities, and how bad debt increases liabilities without increasing those assets. There's just a lot of different perspectives, a lot of different things out there. One thing in that book by Robert Kiyosaki, it talks about how debt can allow you to leverage someone else's money to grow wealth, and I think that's great. That's creating that wealth. There's also a way where you don't have to use other people's money. You can use your own, and I'm excited to share that with you as well. I believe we're on to the next. So, here we talked about bad debt has a pure cost versus good debt, and it increases the value of your money. We talked about the different types. We've already gone over some of those, but really just, increasing those liabilities without increasing assets is what happens with those bad debts. So one of our favorite examples of strategic debt that is using a bank on yourself policy loans, and a couple of reasons why we love them. Is that there's no additional risk to your underlying asset, meaning that your cash value keeps growing whether you take a loan out or not. And that's just a really important point. You can be using your money day to day, and it's also still growing for you. There's not many other places you can find that around. And that's also another reason why people say it's better than paying cash. because you don't lose that compounding. Then also, here we see there's no required payments, although, we recommend that you do, repay. There's no fixed schedule or penalties. You can repay on your own terms when you're able. You're not having there's no fees or penalties for, late payments or anything like that. Yep. And then interest rate is competitive and compounds only once per year. This one's a really great one. It has the simple interest, often, credit cards, stuff like that. That's compounding daily. That's every day. It's compounding here. Simple interest compounds one time per year. That's it. And allows you to, keep more of, that money and not have to pay as much. And then, available through a Bank on Yourself professional. All of us here are Bank on Yourself professionals. And just if you're interested in learning more, want to find out, more about what we do, reach out. We'd love to help you and help you rethink debt and building wealth. What do you guys have anything to say about any comments, any experience with good debt or bad debt?
Yeah, great, Christy. I put the ways to connect with us. We're kind of up on time here. We plan to go for about an hour today, so wanted to make sure we get that out there. The Bank on Yourself type policy loans are also a really great way I've found to pay off debt without destroying my future. That's how Brandon and I got out of student loan debt, was putting money into our policies first and then taking policy loans to wipe out that debt and take power for our future. When we do the math for some people, they end up having an extra 6 figures for their retirement because of strategies like that. It's a lot of fun.
Yeah, I think, again, the bigger thing is the cash flow and having that full working with. So one of us, it's the concept of banking yourself and using those are one piece of the pie, but understanding how debt is accrued, how real estate might be impactful to you, how in a positive way or negative, and also student loans and all those things. We need to be thinking holistically. And so that's what we do as a team here, is we're holistic thinkers, and being able to say, that's a bad debt. Like going and buying a Gucci purse that you can't afford is probably not the best idea. Maybe Stephanie will tell you, not me, but that's a way of thinking about how to use the debt wisely. So thanks, guys, for joining us too. If you want more of these, we want to do more of these lives with our team here, and do more things that impact you, not just debt. I mean, we all are in a world of this debt interesting thing. So we just want to make sure we're providing more value. So if you have comments, if you want us to share some things, put them in there. We'd love to know. And who knows, we will bring it back in next month's episode or something.
Yeah, and I did put 2 comments in over on YouTube, those that might be seen on Facebook. If you have a myth we didn't cover that you'd like to see in a future video, we want to hear from you. And we'd also love to know which debt myth surprised you most. Was it the credit card minimums, let's see if I can remember all of these, the Parent Plus loans and, compared with other ways to pay for college? Was it the not touching your home equity and that there's this home equity loan option? Was it reverse mortgages? Was it 401k loans? Or was it how Bank on Yourself type policy loans work? I'd love to know which one surprised you most, and I'll let somebody else wrap us up.
All right, Stephanie, close us out.
I'll jump in. I mean, I hope this was really informative for everybody. I know this was all game changing for me when I learned it for the first time. And just do your exploration and see what's out there, because there are all sorts of tools that you can use. And as you've seen on this webinar, not everything is created equal.
Boom. Mic drop. Thanks, everybody. Oh, and Dee says Parent Plus loans was definitely a surprise. That origination fee. Yeah, all the things. Thanks, Dee. Glad you're here.